Hello there. This is Sonia Adiago. I want to discuss with you some very important issues that used to affect a lot of traders, especially those that are just coming in into the venture. Okay, so how do you become a winning trader? You know, becoming a winning trader does not mean that you're going to be winning all of your trades. You may even win 4, 5 out of 10 trades and still be a very good winning trader. All right, and all these do not involve that you sit down with your system all of the time. Because there are ways you can trade the market and still be winning and be a winning trader on the short term frame, even on the long run. You'll be a very successful trader for many years. So how do you be a winning trader? How do you become one? All right, the first thing you need to know is that becoming a winning trader involves that you have a very good trading methodology that you understand very well. All right, we have a lot of way people see the market. Some use indicators, some use chart patterns, some use Elliott wave and all that. Okay, if you have a very good trading methodology, for example, I use the Elliott wave. And then with the Elliott wave is a very good methodology that has been used for close to 100 years by a lot of trading professionals and experts, successful traders for so many decades, okay, for close to a century now. So if you have a trading methodology like that, it's actually going to give you an edge. So you're halfway there. Now the second thing is you must try to set up a time frame you are going to be getting your trading opportunities. Okay, you need to have a time frame, right? If you're going to be looking at the hourly chart, probably 1 hour, 2 hour, 4 hour chart, you're going to be looking at the minute chart. You're going to be an intraday trader, like use 15 minutes, 30 minutes, or you're going to be a long term trader, like using the daily chart, or maybe the 4 hour chart, or you're going to be a position trader, or very long term. Like you're going to be using the weekly, the monthly chart, and all that. Yeah, the monthly chart trades that will last for many months. Okay, so you have to also determine, they have to decide on that. Okay, the second one is you should try to risk a fixed percentage of your capital on each position. Okay, anytime you open a position, try to risk a fixed percentage. If you are a technical analyst, a technical trader, then there's no way you are going to know which trade you're going to win or which trade you're going to lose. What you know is that your system can tell you based on what you have, what it has achieved over the time, that you can win, let's say 50, 60 or 70% or 50% of your trades. Okay, for example. But one thing you will not know is the sequence of winning. Okay, you don't know if you are going to win the next two, the next three, or lose the next three or the next four, and all that. So that is why you need to risk a fixed percentage of your capital, so that on every position you open, you are risking the same amount of money. So when you already know, before you open a trade, you know how much you are risking on that trade. You're all right. So that means if you have $500 and you are risking, let's say you are risking 1% of that $500, so that means you're going to be risking $5. So that means before the trade even goes into losing or winning, you already know that the maximum you can lose from the trade is just $5. So you have $495 left, okay, for you to take other trade. So, and that is going to be the major essence of this video, how you can calculate this risk, this fixed percentage, okay, on your capital to trade whatever position you want to open. Okay, the next thing is you try to aim a minimum of 1:2 risk reward. Like the way I use the Elliott wave theory now, I try to make use of it in such a way that I get to the market, identify very good patterns, and I get in early so that I'll be able to get 1:2. And this has been successful 60 to 70% of the time, where I aim 1:2. That means that when I risk $5, for example, I'm going to gain $10 or more. Okay, so this is the minimum. All right, the next one is you should be disciplined to follow through. Now there is it's a different thing for you to understand, to know all this. It's another thing for you to practice them. So you have to be focused and be disciplined. Even if you lose the next 2 or 3 trades, you must always be disciplined and follow through your trading methodology. All right, So without further ado, we're going to learn how we can risk a fixed percentage of our capital on every position that we hope. And there are three major steps. Okay, this should be steps. There are three major steps. Okay, the first thing is you should try to determine the pair you are trading. I mean the currency. I mean the currency pair. Probably the Euro US dollar, GBP US dollar, whatever currency pair you want to trade. You have to determine it, all right, before you even put the trade. And the second thing is you have to determine your percentage risk. Before you immediately you have an account, you must be able to determine, do you want to be risking 1% per trade, if you want to be conservative, or 2%. Okay, if you want to be a bit moderate without being too conservative, 3%. Do you want to be aggressive? Want to be aggressive, that means you'll be going to like 4-5%. And we're going to be very, very, very super aggressive, which is not advisable. That could go as high as 7, 8, 9, 10%. So but that is not advisable at all. So let's now determine, or let's try to know how we can calculate the lot size with a calculator, so we don't have to go through the formula or whatever. So before you open a trade, you just need a calculator to put it through. Okay, let's say for example you want to let me go to the, let's say this is your price chart for example, and then you want to buy euro Canadian dollar for example, and let's say you discover that the wave 2 has ended here. And I'm only picking this example, okay, it's not a call to trade or anything. Let's say you think that you want to buy around here, this place, and you want to set your stop loss below this starting point here. Okay, so that means that if you measure it, that is going to be you're going to be risking about 100 pips. Okay, GBP card, euro card, sorry, about 100 pips. So that is going to be your stop loss. So let's see how that is how we can make use of that. So that's going to be your stop 100 pips stop loss, euro card. So if you want to risk okay, let's go to the calculator. I have the calculator on my blog www.forexsnipersignals.com. it's here. Let me show it to you again. Okay, this is my blog www.forexsnipersignals.com. Okay, so once you get there, you can make use of the calculator. Is down, you just scroll down, just put it so that you can make use of it very quickly. And once you get there, you specify the currency, I mean your account currency. If your account is in dollars, if it is in euros, if it is in pounds, or any other currency you specify, then you put your account balance. Let's say your account balance is 1,000 US dollar for example, and then you just put your risk. Let's say you want to be risking 3% per trade, and then what is the stop loss, which you measured. Let's say like it's 100, just like we saw in euro card. Then you put the currency pair there. This is the base, this is the counter. So we're looking at euro card, so we change this to card. So we have the card there. So we have euro card, 100 pip stop loss, 3% risk, your account balance, and your account is denominated in US dollars. So the next thing is to calculate. So let's calculate that. Okay, now the calculation is done. So amount that you're going to be risking is going to be $30. You're going to be risking $30, which is about 3% of this. Okay, 3% of $1,000 is $30, and this is going to be the standard loss, 0.0396. So approximately that should be 0.04. So that means if you are going to be opening this position, for example, you just buy you go and buy 0.04 lot size of euro card, and then you put your stop loss here. Okay, so that means if you aim 1:2, for example, you're going to be having, instead of $30 that you're risking, you're going to be making $60. So if you can do that for all your positions, it shows that one trade cannot kill you while one trade cannot win you. So that means you are trying to tell the market that you are ready to be patient for a very nice series of trade. You understand? Okay, so let's look at another example. Let's look at another one. Let's say we are looking at the euro new zealand euro new zealand dollar, for example, and then you want to buy. Let's say you want to buy here at this particular price here. I want to put your stop loss here, for example. So what you just need to do is you determine your entry price and then your stop loss price, and then you now calculate how many pips you're risking. Let's say for this one now we are risking 90 pips. So you just come here, you just put 90 pips. 90 pips, you're risking 3% as well on 1000 US dollars. And then this one is going to be euro new zealand dollar. Make sure you are very careful with this. Euro new zealand. That's New Zealand. Okay, now euro new zealand dollar, then you calculate. So this one, you can see that the standard lot size you're going to be using here is more, probably because the stop loss here is lower, and probably because the value of 1 pip of euro new zealand dollar probably is less than that of euro canadian dollar. So this one is 0.04 as well, approximately. That could be 0.05. So that means you are still risking about 3%, or probably 3.0 something percent or thereabout. Okay, so when you want to open this position now, you're going to use 0.04 to enter at the price you are entering from. Okay, so that is how you can make sure that you have a fixed risk, okay, on every position that you open. What is the implication of that? Okay, the implication of that is, if you are using a very good trading methodology, just like the way we use Elliott wave theory, to spot trading opportunities. Let's say you win you on a long series of trade. Let's say you have an average of let's say you have an average of 8 trades, 8 to 10. Let's say you have an average of 10 trades per month, for example. So for 12 months, that's going to be a total average of, let's say, like 220 trades. Okay, if you are risking 3% on this each, I'm using this as an example, and on each of those trades, and let's say you win 60%, which is what we usually see, the minimum that we usually see when we use our Elliott wave methodology, the way I actually use it. Okay, the Elliott wave theory with some other, combined with some other indicators. So let's say you are winning 60% of your trades, so that will give you 72 wins and 48 losses. Okay, let's say you are targeting like 2%. I mean, you are making you are getting 1:2 risk reward of all this. So that means that if you multiply this by 6%, that means you're going to have to remember, that's about 43, right? Am I correct? At the end of the year, 43, 132% winners, and then the losers would be 3 times 8, so 4, 2, that's 144 percent. Oh, sorry about that. So you have 144 percent. So if you subtract them, do I have a calculator? So okay, let me use my head. So you have 8, you have 8, and then you have 2. So that is 288% at the end of the year. Okay, just winning 60% of 1:2, 288%. So if you are risking, let's say, like 1% now, you are risking 1% instead of 3%. So that means that you're going to be having like you divide this by 3, that's 96%. So even if you are risking 1% per trade, okay, that means you can make a 96% profit at the end of the year. And if it is 2%, that means you can make about 192% at the end of the year. Okay, what about if you make let me remove all this. So that means for 1 to 3% on 60, for 1 to 3% risk, okay, on 60% winners and for a 1:2 risk reward, that means you could make between 96% to 288% on 120 trades you take in a year, which is a very good return. Okay, 96% is a very good, very good return. Okay, now what about if you ask me if because you make a lot of errors, some errors and all that, what about if you are not able to get up to that? What about if you win 50% of those positions, of those trades on 1:2? Let's see what you're going to get. If you risk 50%, so that means you're going to win 60 and lose 60. Okay, if you risk let's say 1% now, you make 2% per trade, so you have 120 here, and then you 1% loss, so you lose 60%. So if you subtract them, you are going to make 60% at the end of the year. So that means even if you win half of your trades on this 1 to 2 risk reward ratio, risking a fixed percentage, so that means that on risking 1% per trade, you can still make 60% per annum. So if you are risking 3%, for example, that could be 180% per annum. Okay, so what about if you risk, if you, let's say you have 40% winners, okay, for example, okay, let's look at 40% winners on 120 trades, 40% winners, that means you're going to win 48, and then you lose 72. If you risk 1%, so that means for every winners you make 2%, and then you multiply them, you have 96 winners, and then times 1, you have 72. Okay, so if you subtract, so that's going to be 24%. Guys, 24% on 40% winners on 1:2. Now I want you to think about it. So if you are risking 3% now per trade, that is going to be 72%. Okay, so imagine that. I wonder how people blow accounts if you focus on the risk reward ratio and you have a very good trading methodology that can give you 1:2 risk reward, and you are risking a fixed percentage of your capital. There's no reason for you to lose a fund. Okay, because even if you go down and assuming you are winning even 30% of your trade, okay, that is when you are probably going to have a very little loss. Okay, very little loss. So there's no point losing an account if we can just be focused on these steps and risking a fixed percentage of our capital, and we don't have to stress ourselves, because we know that even if you win 2 3 trades, or if you lose 3 consecutive trades, you can always win more. Okay, well, because if you win the 3 consecutive trades, if you lose 3 consecutive trades and you win the next one, so the next one that will win, I've already covered for 2 of these losses. So if you now have a system that can give you 60% of your positions on 1:2, okay, and you are having like 8 to 10 trades per month, now calculate it. You are risking 2% or 1%, you're definitely going to be looking at making about 100%, or if you're very conservative, like 72%, or on a very bad year, you can be looking at 24% for a very conservative trader. Okay, so what more do we need when we have this kind of knowledge? Okay, there's no need to be blowing our account, there's no need to be scared. You just learn this methodology. Okay, so that is what I think, that is how winning is done. Okay, so you can how do you go from here? Okay, from this explanation that I've given you, because everything is still narrowed down to good trading methodology, and then it goes down like that. Okay, there are three things I can actually do for you. You can subscribe to my Elliott Wave trade setups, and then it's a service that you subscribe to, and I give you trade setups with entries, exit, and the minimum you'll be targeting is 1:2. And then I'm also going to be giving you updates on how to manage them, whether it's time to exit. Because I also discovered that out of the 40, if you win 60%, let's say if you win 50%, even out of the 50%, there are some trades you are going to stop at break even. There are some trades you are going to reduce the stop loss by half. So you are not going to lose all of this 50% actually. The 50% winners are the ones that hit the second TP. That is what I'm actually talking about when I say 60% winners. Okay, I'm not talking about something that you risk 50 pips and you are making another 40 pips. I don't, based on what the way I trade, I don't actually consider that as a winner yet until it gets to 1:2. So that's the 50, 60% or 40% winners that I'm talking about. While out of the losers, 50% or whatever percent, then that one is we are going to find a way of cutting them if they will have a chance to do that. Okay, so do we have a better way of winning than trying to make sure that we win more and we cut our losses? Okay, so you can subscribe to these Elliott Wave setups that will be delivered to you with analysis and trade management, or you can just subscribe to my training and mentoring program. Okay, whereby you can get my complete training course, and then my mentoring. You're going to learn this system completely, and I'm also going to mentor you for 1 month or 3 months or 6 months, even or 1 year, depending on how you want it to be. Okay, but each of them comes with different prices actually. And then you can also subscribe to my daily Elliott analysis. Probably you don't do all this. You know that Elliott Wave has 1, 2, 3, 4, 5, and you have a system that trades the trend. You want me to spot with 3 for you, or with five for you on any time frame. Probably you are using an EHE. Then you can subscribe to this daily Elliott analysis, whereby you get 2 analysis per day. Okay, one, and then an update later in the day. All right, for whatever number of currency pairs you're following. And so these are my contacts, so you can reach me on any one of them. I hope you enjoy this video. Please don't forget the essence of this video. Okay, the essence is for you to be a winning trader, and if you can follow all those things, you have a methodology that give you a 1 to 2 risk reward, profitability. Okay, sorry, risk reward when you win, and you are having like 60%, 50% winners, then it shows that you're going to become a winning trader at the end of the day. And then we also learn how you can calculate the percentage risk on your trades with a calculator. All right, thank you very much. This is Somi Adiago. I want to say thank you very much. You can subscribe to my YouTube channel, all right, so that you can, when anytime I upload new videos, new analysis, you'll be told, a mail will be sent to you by YouTube. You'll be notified. All right, thank you very much. Bye.